Why don't I get out of the market when times are bad and get back in when times are looking up? As an advisor, investors sometimes ask me this. It's a reasonable thing to ask. Who doesn't want to avoid the bad times and gain from the good ones? The problem is there's no crystal ball to tell us when to exit the market and when to get back in. And unfortunately, those who think they have this secret knowledge often learn otherwise the hard way. In this episode of Glad You Asked, we'll discuss one big lesson the market has taught us over the last many decades. That is the importance of staying invested. My experience as both an advisor and an investor has underscored this teaching. The temptation to exit the market in a downturn is understandable, but it can also have unintended consequences, as illustrated by the following story I heard not long ago. In late 2019, a doctor in Philadelphia read about health developments in Wuhan, China. He predicted the U.S. would soon undergo a similar influx of COVID infections. Expecting a coming pandemic and a slump among stocks, he got out of the market entirely. He was right. The pandemic did come to this country, and when the Dow dropped by almost 40% between February 12th and March 23rd, the doctor was lauded for his foresight. Other investors who had kept their money in looked at his example and said, "If only I had been as wise." And then came March 24th, 2020. The Dow surged by more than 11%, the market's best day since 1933. Then, from its lows in March until year-end, the S&P 500 jumped almost 65%. The doctor, having initially been quite pleased with his decision, ended up missing all of it. What was at first deemed prescient turned out to be a major error. History is full of similar examples demonstrating the importance of staying invested. In today's video, we'll take a look at the stock market through a few different lenses. First, we'll examine crucial individual days in the market since the year 2000. Next, we'll address a fear common to investors, the prospect of a major sudden downturn, and how past downturns impacted markets and portfolios. Then we'll examine market performance over longer periods and why we invest. Finally, why does the pain of a market decline seem so much stronger than the pleasure of a rally? You remember what a pogo stick is. They go up, they go down, they go up, they go down, but at the end of the day, they don't go anywhere. You end up right where you started. Is that who you want to be as an investor? When I meet with prospective new clients, they sometimes come with a history of jumping in and out of the market, despite targeting a longer time frame. Often, they express frustration about how their accounts had performed during this time. To help illustrate the folly in this approach, we often discuss the importance of remaining invested in order to not miss the market's best days. You might wonder, how important can a single day be when we're talking in terms of years or even decades? To answer this, imagine an investor with $10,000 in the market at the start of 2002 who never touched it before 2022. In that time, his investment grew to roughly $60,000. But what if that investor happened to pull out of the market right before its 10 best days in that 20-year period and got right back in after those days? His $60,000 would be cut in half to $30,000. And that's because he missed only 10 days. It would be even worse if that investor missed the best 20 days, and worse still if he missed the best 30. The point is, the biggest relative gains can happen in a very short period, as short as a single day. But guessing those days is very hard, nearly impossible. The biggest day could be tomorrow, or in 6 months, or in 6 years. It's far easier to stay invested than hop in and out of the market based on uncertain predictions. Talk with us before being a pogo stick investor. When markets decline, I often receive calls, particularly from newer investors, to check whether they should change their investments or get out of the market entirely. In early 2020, as the market was still adjusting to the new reality of life during COVID, many investors inquired whether they should reduce the percentage of stocks in their portfolios. Even in better times, I often hear investors remark that they want to be sure they avoid the next big market decline. To be clear, there's no guaranteed method to avoid losses, but it's worth considering major market declines in their historical context. The market has had several downturns related to big historical events over the last century. The biggest drop came during the Great Depression, when, at its lowest point, the market had collapsed by almost 90%. Periods around 9/11 and the 2008 financial crisis were followed by contractions of around 50%. But those declines are only part of the story. Each of the worst events of the last century was followed by a striking market recovery. A year after its lowest point in the Great Depression, the market had grown by more than 1.5 times. Within 5 years, almost 3.5 times. Rebounds after more recent events have been quite strong as well. Large gains came as soon as the 1-year mark. And look at the 5-year mark after each low point. The market had gained back all of its losses, and in some cases, much more, within a half-decade of hitting bottom. Mark Twain said, "History doesn't repeat itself, but it often rhymes." As investors, we can look to history for how the market has performed following market declines and have confidence that the decision to stay invested is often the right one. When I meet someone in a social setting, I'm frequently asked, "How did the market perform today?" When they hear the market's up, they often smile. When it's down, it's a frown. Earlier, we talked about the importance of staying invested to avoid missing out on big one-day market gains. We discussed what a difference a day can make when you're invested versus when you're out of the market. Once you're invested in the market, though, it's worth thinking of day-to-day fluctuations in a historical context. This chart dates back to 1937. It shows that the percentage of days the market was up from one day to the next was only about 50-50. However, the longer the time frame, the greater the likelihood that the market was up. Looking back at each 1-year period since 1937, the market was up nearly 80% of the time. And over each 10-year period, the market was up over 97% of the time. Instead of worrying about the market's day-to-day swings, you're likely better off focusing on your own long-term goals. We all know the media can make this difficult to do. Hyping declines and stoking fears are ways for the press to grow their audience numbers. But remember, the media aren't paid to be right. They're paid to be heard. Daily volatility gives them occasion to make noise, but in the long term, it's usually only that. Noise. History teaches us that the longer we stay invested, the better our odds are of reaping gains. So far, we've discussed reasons why staying invested is often the best approach. During a market decline, investors often find comfort after making a change to their investments. While this activity can be comforting, it can also be the wrong decision for your portfolio. Short-term ups and downs are no fun, and it's human to want to avoid losses. Research has shown the pain of loss is thought to be 2 to 3 times the pleasure of a gain of an equal amount. Let me say that again. The pain of loss is thought to be 2 to 3 times the pleasure of a gain of an equal amount. These feelings of pain and pleasure often translate to investors buying more when the market is up and selling more when the market is down. It's important to remember, market declines are a normal part of investing, and they can present opportunities for long-term investors. By staying disciplined and keeping a long-term perspective, you can navigate through market downturns and position yourself for potential future growth. Let's recap the 3 important takeaways from today's video. Number 1, focus on the long term. A market decline may seem unprecedented, but we've seen similar market reactions before. History may not repeat itself, but it often rhymes. Number 2, consider staying invested to capture the best days. It's possible to miss out on big market gains by just one day. Talk with us before trying to time the market. Number 3, look past short-term fluctuations. Don't let the media's hype or others' fears about ups and downs overwhelm your long-term goals. As Warren Buffett says, the stock market is a device for transferring wealth from the impatient to the patient. Nothing is certain, and we can't predict the future. But time and again, patient investors have been rewarded for waiting things out. Thank you for watching this episode of Glad You Asked. If you ever have financial questions or concerns, please don't hesitate to reach out to us. Thank you again, and have a great day.